What if I told you that the greatest investor of all time, the man who turned a failing textile mill into a $900 billion empire, built his fortune not on secret formulas or high-risk bets, but on a few simple truths that anyone can learn and most people ignore? Warren Buffett isn't just a billionaire. He's a philosopher in disguise. His wisdom about money, decision-making, patience, and human behavior is so precise, so timeless, that people all over the world try to decode it. But the new Tao of Warren Buffett does something different. It doesn't just tell you what Buffett does, it reveals how he thinks. And once you see the world through his lens, your relationship with money, success, and even your own choices will never look the same. Imagine having a quiet conversation with Warren Buffett in his Omaha office. No cameras, no crowd, just the Oracle of Omaha telling you why most people stay broke, why the smartest decisions in life often feel uncomfortable, and why you don't need to be rich to start thinking like an investor. That's what this book feels like. It's a collection of the strongest mental principles Buffett has lived by for decades, extracted and simplified so you can apply them immediately. Here's the twist: Buffett's wisdom isn't flashy. It's not the 10x your income in 30 days advice you see everywhere online. In fact, it's almost the opposite. His Tao is about slowing down, thinking clearly, ignoring noise, and understanding human nature better than Wall Street ever will. Because in Buffett's world, mastering yourself is more valuable than mastering the stock market. And that's exactly why this book hits so hard. You'll discover why Buffett believes that the best investment you'll ever make is in your own character, why he thinks a calm mind beats a brilliant mind, and why opportunity doesn't come from searching, it comes from waiting. These aren't motivational quotes. They're operating principles that Buffett uses to make billion-dollar decisions with the same calm confidence most people use to order lunch. But here's the real question. If Buffett's ideas are so simple, if his rules are so clear, if his success blueprint is right in front of us, why doesn't everyone follow it? The answer is the heart of this book and the heart of this video. Because Buffett's wisdom forces you to confront uncomfortable truths about money, patience, discipline, and ego. It's not hard to understand, but it is hard to practice. And that's why the small percentage of people who truly embrace it end up wealthier, calmer, and more successful than they ever imagined. So today, we're stepping inside Warren Buffett's mind. We're breaking down the Tao, the philosophy behind one of the greatest financial lives ever lived. And by the end of this video, you'll walk away with a new way of thinking about wealth, risk, happiness, and opportunity, one that could quietly change the entire trajectory of your financial life. Let's dive into the new Tao of Warren Buffett. Chapter 1 of the new Tao of Warren Buffett opens with one of Buffett's most famous and deceptively simple principles. Rule no. 1. Never lose money. Rule no. 2. Never forget. Rule no. 1. Double quotes. Mary Buffett and David Clark use this chapter to break down what Buffett really means by these rules, because on the surface, they sound unrealistic. Every investor loses money at some point. Every market fluctuates. Every business faces risk. So how can someone like Buffett insist on a rule that seems impossible? The authors explain that Buffett's rule is not about avoiding market volatility or never seeing the price of a stock dip. It's about avoiding permanent loss of capital, the kind of loss that comes from buying the wrong business, overpaying, or failing to understand what you're investing in. Buffett's central idea is that most losses are not caused by random market swings. They are caused by bad decisions made upfront. If you choose wisely, volatility becomes irrelevant. If you choose poorly, volatility becomes catastrophic. Buffett approaches investing the way a business owner would evaluate buying an entire company. Before he decides to buy even a single share, he asks the same questions a rational owner would ask. Is this business durable? Does it have predictable earnings? Does it have a competitive advantage that will last for years? This mindset naturally eliminates most high-risk, speculative investments. For Buffett, avoiding losses starts with avoiding companies he cannot fully understand. The authors emphasize that for Buffett, risk comes from not knowing what you're doing. The chapter uses several examples from Buffett's career to illustrate how he has consistently applied this philosophy. He avoids companies with complicated financial structures, weak brands, or businesses vulnerable to technological disruption. Instead, he focuses on what he calls predictable economics. These are businesses with stable demand, strong consumer loyalty, and the kind of pricing power that protects profits even in tough economic climates. Coca-Cola, See's Candies, and Gillette are referenced as classic Buffett-style investments companies where the product will still be in demand 10 or 20 years from now. That predictability dramatically reduces the chance of permanent loss. Another key element discussed in Chapter 1 is the importance of buying at the right price. Buffett does not invest simply because a company is great. He invests when the price provides what he calls a margin of safety. This margin shields him from downside risk. If unexpected events occur, the low purchase price protects his capital. If the business performs as expected, the investment compounds at a high rate. Either way, the margin of safety makes losses unlikely. Thus, never lose money is less about perfection and more about building a buffer against uncertainty. The chapter also highlights Buffett's ability to stay emotionally disciplined. Many investors lose money because they chase trends, react to market fear, or assume that rapid gains can compensate for sloppy decision-making. Buffett, however, treats investing as a long-term commitment. He is willing to wait indefinitely for the right price, and he refuses to be influenced by market hype. His discipline is part of what makes Rule No. 1 possible. Emotional mistakes, the authors suggest, destroy more wealth than bad luck ever could. Ultimately, Chapter 1 sets the tone for the rest of the book. It's a reminder that Buffett's success is not built on secret tactics or complicated financial models. It is built on a relentless commitment to not losing money, which in practice means avoiding speculation, focusing on economic predictability, understanding the business deeply, buying with a margin of safety, and staying patient enough to wait for the right opportunity. By redefining risk as the probability of permanent loss rather than short-term fluctuations, Buffett turns investing into a game of discipline, clarity, and thoughtful decision-making. And everything else in the book builds from this single foundational idea. Chapter 2 of the New Tao of Warren Buffett expands on one of Warren Buffett's core behavioral principles, the discipline to avoid action until the right opportunity appears. The authors explain that Buffett's success is not built on constant activity, but on selective decision-making. The chapter highlights a central Buffett idea that separates great investors from average ones. You are never obligated to act. In investing, unlike baseball, there is no penalty for not swinging. You can stand at the plate indefinitely watching pitch after pitch go by until a perfect one appears. The chapter stresses that most investors lose money not because opportunities are scarce, but because they take action too quickly. They feel pressure to do something, buy, sell, react to news, or chase trends because the market environment makes an activity feel irresponsible. Buffett, however, sees inactivity as a strategic advantage. He believes that only a handful of opportunities in a lifetime are truly worth pursuing, and therefore, the rational investor must be ready to ignore the rest. Mary Buffett and David Clark give context for Buffett's selective behavior. He reviews thousands of pages of business information each year and monitors hundreds of companies, but he commits to only a small number of investments. His standard for action is extremely high. A company must demonstrate durability, understandable economics, strong competitive advantages, trustworthy management, and a price that provides a margin of safety. If any of these components is missing, Buffett simply waits. The authors emphasize that waiting is not a sign of indecision, it is a form of risk control. The chapter also highlights that opportunities which meet all of Buffett's criteria are rare by nature. The scarcity is why discipline becomes essential. Most investors try to make every opportunity fit their strategy. Buffett only moves when the opportunity naturally aligns with what he calls predictable economics. The authors explain that predictable economics refers to businesses with stable, measurable, and repeatable financial performance. Companies with volatile earnings, unproven models, or industries heavily influenced by unpredictable technological change rarely make it into Buffett's consideration set. A key theme of Chapter 2 is that Buffett's patience is active, not passive. While waiting for the right pitch, Buffett spends enormous time preparing, reading annual reports, studying industries, understanding long-term trends, and analyzing management behavior. This preparation ensures that when the right opportunity finally appears, he can act immediately and with full confidence. The chapter notes that Buffett's biggest successes often come from investments where he had followed the business for years before buying a single share. His readiness comes from long-term observation, not from quick reactions. The authors contrast this mindset with typical investor behavior. Many individuals and even professional managers feel pressure to constantly demonstrate activity. They buy because others are buying, or they sell because the market is falling. This reaction-based approach leads to decisions driven by emotion rather than analysis. In Buffett's framework, such behavior increases the probability of loss. In contrast, waiting eliminates the need to make rushed decisions and gives the investor the mental clarity to choose only high-quality opportunities. The chapter concludes by emphasizing that Buffett views patience as a competitive advantage. Markets reward those who can resist noise, ignore short-term fluctuations, and stay committed to long-term principles. By refusing to act without clear justification, Buffett minimizes the chance of permanent capital loss, echoing the philosophy introduced in Chapter 1. The authors reinforce that for Buffett, the ability to wait is not optional. It is foundational to intelligent investing. The investor who does not feel compelled to participate in every market movement will always be in a stronger position than the investor who acts out of fear of missing out. Ultimately, Chapter 2 teaches that great investing is less about finding opportunities and more about filtering them. Those who master the discipline of waiting armed with preparation, clarity, and a willingness to say no position themselves for success when the rare, high-quality opportunity finally arrives. Chapter 3 of the new Tao of Warren Buffett centers on a concise but critical Buffett principle. If you don't know jewelry, know the jeweler. The authors use this statement to illustrate a broader concept. When your knowledge is limited in a particular domain, the quality of the advisor you rely on determines the outcome. This chapter expands on how Buffett evaluates expertise, whom he trusts, and why most investors go wrong by listening to the wrong people. Mary Buffett and David Clark explain that Buffett's saying originates from a simple truth. Every industry has insiders who understand nuances that outsiders can't easily see. Jewelry is a classic example because the true value of a gemstone often cannot be independently verified by a casual observer. Unless you are an expert, you must depend on someone who is not just someone with experience, but someone whose incentives align with your own. The chapter uses this metaphor to demonstrate how Buffett approaches decision-making in fields outside his direct expertise. The authors clarify that Buffett is not advocating dependence or passivity. Instead, he emphasizes the importance of selecting the right experts when specialized knowledge is required. Buffett understands that no investor can master every domain. Therefore, the rational strategy is to identify advisors who are not only competent, but trustworthy. This leads to one of Buffett's key filters. He only works with people whose interests are aligned with his and whose behavior has proven consistent over time. In the investment world, Buffett sees a major flaw. Many individuals rely on advisors who are not incentivized to protect their capital. Brokers are often compensated through commissions, encouraging frequent trading rather than wise decision-making. Analysts may be influenced by corporate relationships or market pressures. Financial media rewards sensationalism, not discipline. According to the chapter, trust placed in the wrong jewelers leads to predictable losses. Chapter 3 explains how Buffett has built a network of reliable experts throughout his career. These individuals are not chosen for their credentials alone, but for their integrity, long-term thinking, and economic alignment. For example, when Buffett invests in industries outside his own circle of competence, he consults people with decades of operational experience, not short-term commentators. These trusted experts allow him to fill gaps in his knowledge without exposing himself to unnecessary risk. A key theme of the chapter is the alignment of incentives. Buffett consistently avoids situations where the advisor's compensation structure encourages behavior that could harm investors. He prefers simple, transparent arrangements where rewards only come when he benefits as well. The authors highlight that Buffett values no-conflict relationships where advice is given, because it is sound, not because it generates fees. The chapter contrasts Buffett's method with typical investor behavior. Many individuals rely on tips, trends, or opinions from people they barely know. Others depend on professionals who may be skilled but have conflicting motives. The lack of alignment creates what the authors call structural risk that arises not from the investment itself, but from the decision-making environment. Chapter 3 also reinforces Buffett's broader philosophy of staying within one's circle of competence. When he does not understand an industry deeply enough, he does not attempt to guess. Instead, he either rejects the opportunity or seeks a specialist who can evaluate the business objectively. The jeweler metaphor serves to remind investors that ignorance is not dangerous, acting on ignorance is. Toward the end of the chapter, the authors point out that selecting the right advisor is not just about intelligence. It is about character, consistency, and transparency. Buffett trusts people who admit what they don't know, who base their decisions on data rather than emotion, and who have proven dependable under pressure. These qualities are far more valuable than sophisticated models or industry jargon. Chapter 3 ultimately provides a practical and replicable lesson. Investors should be extremely selective about where they get advice. When you lack expertise, the safest path is to rely on someone who has both competence and aligned incentives. The wrong advisor can create hidden risks. The right advisor can protect you from them. Chapter 4 centers on one of Warren Buffett's most direct and uncompromising principles. You can't make a good deal with a bad person. Mary Buffett and David Clark explain that Buffett's investment philosophy is not only about analyzing numbers, competitive advantages, and long-term economics. It is equally about assessing the character of the people running a business. In Buffett's view, the integrity of management is a non-negotiable factor because even a strong business can be destroyed by dishonest or unethical leadership. The chapter outlines Buffett's reasoning when people in charge manipulate information, hide weaknesses, or act in their own self-interest. Investors face risks that cannot be calculated through financial statements alone. A dishonest manager can overstate earnings, distort performance metrics, or take actions that benefit themselves while harming shareholders. These risks are invisible until damage becomes irreversible. Therefore, Buffett eliminates them by refusing to work with people he cannot fully trust. Mary Buffett and David Clark highlight that Buffett has repeatedly avoided deals, even profitable ones, simply because he doubted the character of those involved. Conversely, he has pursued investments where the economics were solid and the leadership demonstrated transparency, ethical behavior, and long-term orientation. Buffett prefers managers who treat shareholders as partners, communicate honestly, and operate with consistent discipline. The authors emphasize that character screening is a defensive strategy. It reduces exposure to fraud, mismanagement, and reputational harm. Buffett believes that ethical people create predictable environments, and predictability is essential for long-term compounding. Chapter 4 concludes that for Buffett, integrity is not optional. A company without trustworthy management is uninvestable, regardless of its market position or financial performance. The message is straightforward: bad people create bad outcomes, and the best protection for any investor is to avoid them entirely. Chapter 5 focuses on Warren Buffett's principle that independent thinking is essential, especially in environments where group behavior dominates. Mary Buffett and David Clark explain Buffett's warning: a public opinion poll is no substitute for thought in investing and business decision-making. Relying on majority opinion is often a shortcut that leads to poor outcomes. Buffett argues that markets frequently reward those who can think clearly, when others are simply reacting. The authors highlight that financial markets are heavily influenced by herd mentality. Investors chase what is popular, avoid what is temporarily out of favor, and often make decisions based on headlines rather than analysis. Buffett's philosophy is the opposite. He makes decisions based on his own assessment of a company's intrinsic value, not on what others believe the value should be. This approach allows him to stay rational during periods of excessive optimism or fear. Chapter 5 emphasizes that true independent thinking requires two components: Accurate information, derived from primary sources such as annual reports and direct company data. The discipline to rely on one's own judgment, even when it contradicts majority opinion. Buffett trusts his analytical process more than market sentiment. If he determines that a business has durable economics and is selling at a discount, he buys regardless of whether the public agrees. Likewise, if the crowd is enthusiastic about a stock that lacks predictable long-term performance, Buffett avoids it entirely. The authors also point out that independent thinking reduces emotional decision-making. When investors follow the crowd, they inherit the crowd's fears and excitements. Buffett's method shields him from this volatility because his decisions are grounded in logic, not social pressure. Chapter 5 concludes with a clear message. Successful investing requires thought, not consensus. For Buffett, genuine analysis is more valuable than public opinion, and those who can think independently gain a long-term advantage in any market environment. Chapter 6 of the new Tao of Warren Buffett warns investors about one of the biggest hidden dangers in finance: relying on analysts, advisors, or brokers whose incentives and motives don't align with yours. Mary Buffett and David Clark explain why trusting these intermediaries often leads to poor decisions, and why Buffett prefers to see through the noise and do his own homework. The core idea is simple but powerful. Many advisors are compensated based on activity, commissions from trades, fees for services, or bonuses tied to frequency of transactions. Their business model depends on creating problems to justify their help. That means they often exaggerate risks, hype up opportunities, or encourage unnecessary trading. For an average investor, following their advice means chasing commissions, not value. Buffett, on the other hand, treats a stock as a stake in a business, not a ticket to trade. He avoids paying for advice that pushes action for action's sake. Instead, he reads primary sources' company annual reports, financial statements, and builds his view from first principles analysis. If a business meets his strict criteria, understandable business model, strong economics, honest and able management, and a price that gives a margin of safety, he invests. If not, no matter how enticing the pitch, he walks away. The chapter argues that many market forecasts, analyst reports, or broker recommendations are structured to serve the provider's interests more than the investor's. Their forecasts are often speculative, short-term oriented, and backed by incentives misaligned with long-term value. In Buffett's view, these create structural risk not from the business itself, but from the decision-making environment. Ultimately, Chapter 6 emphasizes a central lesson: avoid relying on external experts whose motives may conflict with yours. For Buffett, the only reliable advisor is data, the company's own numbers, combined with rigorous, independent thinking. For any serious investor, this means do your homework, understand what you own, and don't let brokers, analysts, or hype shape your decisions. Chapter 7 focuses on Warren Buffett's analysis of inflation and its impact on investment performance. Mary Buffett and David Clark explain that inflation is one of the most powerful forces eroding investor wealth, and Buffett considers it a silent tax that punishes businesses unable to raise prices or maintain profitability when costs rise. The chapter highlights Buffett's central argument: not all businesses are equally equipped to handle inflation. Companies with weak pricing power, heavy capital requirements, or low profit margins suffer disproportionately because they must reinvest larger amounts of money simply to maintain their existing earning capacity. Inflation forces them to spend more on inventories, equipment, labor, and replacement assets. When these businesses cannot pass increased costs to consumers, their real returns shrink. Buffett prefers businesses with characteristics that protect them from inflationary pressure. These include strong pricing power, the ability to raise prices without losing customers; high returns on equity, allowing the company to generate profits without constant reinvestment; low capital expenditure requirements, businesses that do not need large amounts of cash to sustain operations; brand strength or competitive moat, enabling the company to maintain customer loyalty even as prices increase. The authors use Buffett's perspective to emphasize that inflation exposes the weakness of companies, that rely heavily on tangible assets. In contrast, companies with valuable intangible assets, such as brand strength or proprietary products, can often raise prices more easily and preserve shareholder value. The chapter also stresses a broader lesson. Investors must evaluate how a business performs in real inflation-adjusted terms, not just nominal terms. A company may appear profitable, but if inflation consumes most of those gains, the investor's purchasing power declines. Chapter 7 concludes with Buffett's practical guidance. Long-term investors should favor businesses that can retain earnings power regardless of macroeconomic conditions, because these companies survive inflation with minimal damage and often emerge even stronger. Chapter 8 presents one of Warren Buffett's most widely cited investment principles. Quality matters more than price alone. Mary Buffett and David Clark explain that Buffett evolved from buying cheap companies. Ben Graham's deep value approach to buying high-quality businesses, even if their stock price appears higher than typical value investing targets. The shift is rooted in a simple insight. Outstanding businesses compound capital at superior rates for long periods, making them far more valuable over time than mediocre companies purchased at bargain prices. The chapter breaks down why wonderful companies outperform fair companies. Sustainable competitive advantage. High-quality businesses possess economic moats, brand loyalty, pricing power, cost advantages, or unique products that protect profitability and produce predictable cash flow. Strong returns on equity. These companies generate high returns without requiring large reinvestments. That means profits can be reinvested internally at attractive rates, driving exponential long-term growth. Lower risk over time. Strong businesses can withstand economic cycles, competitive pressure, and inflation better than weaker firms. By contrast, fair companies have fragile economics that deteriorate when conditions change. Management quality. Buffett emphasizes that outstanding businesses are usually led by capable, disciplined, shareholder-oriented managers, an essential factor in long-term value creation. The authors note that investors often get distracted by low price-to-earnings ratios or temporary discounts, mistaking them for bargains. Buffett warns that a cheap price cannot fix a flawed business model over time. The weaknesses of a fair company compound negatively, while the strengths of a wonderful company compound positively. Chapter 8 concludes with a strategic takeaway. Paying a fair price for excellence almost always beats paying a low price for mediocrity. The performance gap widens dramatically over long horizons, making quality the core driver of superior investment results. Chapter 9 focuses on Warren Buffett's requirement that a truly great business must possess a durable, long-lasting competitive advantage, what Buffett calls a moat. Mary Buffett and David Clark explain that without a moat, a company's profits are vulnerable to competition, price pressure, and market disruption. With a moat, however, the business can protect its earnings power for decades. The chapter identifies several types of competitive moats that Buffett looks for. Brand strength and consumer loyalty. Businesses like Coca-Cola or Gillette maintain dominance because customers consistently prefer their products over alternatives. This loyalty creates pricing power, a critical factor in long-term profitability. Cost advantages. Some companies operate at lower costs due to scale, efficiency, or proprietary processes. This allows them to underprice rivals while maintaining healthy margins, making it difficult for new competitors to gain traction. Network effects and market position. Companies with entrenched distribution networks or industry-leading market share benefit from structural advantages that competitors cannot replicate quickly or cheaply. High switching costs. If customers face inconvenience, expense, or operational risk when switching to a competitor, the incumbent business becomes extremely resilient. The authors emphasize that a durable moat ensures predictable earnings, which is essential for Buffett's valuation process. Predictability reduces the risk of permanent capital loss and allows compounded returns to accelerate over long horizons. Chapter 9 also warns that companies without moats may experience temporary success, but their profits erode as soon as competition intensifies. Buffett avoids these businesses because their future cash flows are uncertain. and vulnerable to industry changes. The chapter concludes with a straightforward insight. A company's moat is its best defense against competition and the foundation for long-term compounding. For Buffett, identifying and understanding this moat is a non-negotiable step in assessing investment quality. Chapter 10 reinforces Warren Buffett's principle that an investment should be evaluated based on the long-term economic performance of the underlying business, not short-term market fluctuations. Mary Buffett and David Clark explain that Buffett buys companies with the mindset of a business owner, not a trader. His test is simple. Would you still feel confident owning this company if the stock market closed for the next decade? This principle forces investors to ignore short-term price movements and focus entirely on the durability, predictability, and long-term value creation capacity of the business. According to the authors, Buffett's approach eliminates speculation because it requires the investor to understand the company well enough to trust its intrinsic performance rather than market sentiment. Chapter 10 outlines the conditions a company must meet for Buffett to comfortably hold it for 10 years. Stable and understandable business model. The company must operate in an industry with slow, predictable changes rather than rapid innovation cycles. Consistent earnings power. Businesses with volatile earnings fail the 10-year test because their long-term performance is uncertain. Strong competitive advantage. A durable moat ensures the company can maintain profitability even as industry dynamics evolve. High return on equity with low debt. Buffett wants companies that grow primarily through internal cash generation, not leverage. Competent, honest management. Long-term ownership requires full confidence in leadership's discipline and shareholder orientation. The authors highlight that this mindset protects investors from emotional decisions. When market prices drop, an investor who understands the underlying economics is less likely to panic because value is measured by the business, not the ticker price. Chapter 10 concludes with a clear directive. If a business is not strong enough to hold for 10 years without a market quote, it is not strong enough to buy at all. This long-term orientation is central to Buffett's strategy and one of the primary drivers of his compounding success. Chapter 11 focuses on one of Warren Buffett's most important behavioral insights. The greatest threat to an investor's success is not the market, but the investor's own emotions and psychological biases. Mary Buffett and David Clark explain that markets are driven by cycles of fear and greed, and most people get caught in these emotional swings, making decisions that contradict long-term investment logic. The chapter highlights that investors often buy when prices are high, typically during periods of optimism, and sell when prices fall, driven by fear. This behavior creates a predictable pattern of buying high and selling low, which is the opposite of rational investing. Buffett stresses that controlling one's temperament is far more important than having a high IQ or access to sophisticated financial models. The authors break down the common behavioral pitfalls Buffett warns against. Overconfidence. Investors often believe they can outsmart the market, leading to excessive trading. Herd mentality. Following the crowd creates pressure to act based on social sentiment rather than independent analysis. Short-term thinking. Emotional reactions to temporary price movements override long-term fundamentals. Loss aversion. The fear of losing money causes investors to sell prematurely or avoid sound opportunities. Buffett's counterstrategy is to rely on discipline, patience, and a clear analytical framework. He focuses on intrinsic value rather than price action and avoids making decisions during emotional extremes. By grounding decisions in logic and long-term thinking, he mitigates the psychological errors that plague most investors. Chapter 11 concludes that mastering one's own behavior is a competitive advantage. Investors who remain calm, rational, and independent, especially during turbulent markets, position themselves for long-term success. Buffett's message is simple. The mind is the investor's strongest asset, and also his biggest liability, depending on how it is managed. Chapter 12 emphasizes Warren Buffett's belief that the highest return investment any individual can make is in their own skills, knowledge, and personal development. Mary Buffett and David Clark explain that external investment stocks, bonds, or businesses can fluctuate in value, but improvements in one's abilities compound for a lifetime and cannot be taxed, inflated away, or taken by market volatility. The authors note that Buffett's philosophy centers on building personal competitive advantage, similar to the economic moats he seeks in companies. For individuals, this advantage comes from strong communication skills, clear thinking, financial literacy, and a disciplined decision-making framework. Buffett frequently credits his own success not to shortcuts or market predictions, but to long-term investments in understanding business fundamentals and improving his analytical abilities. Chapter 12 highlights several areas where Buffett believes personal investment yields the highest return. Communication skills. Buffett argues that the ability to communicate both in writing and speaking raises one's lifetime economic value dramatically. It improves decision-making, leadership, and the ability to persuade or negotiate effectively. Continuous learning. The chapter reinforces Buffett's habit of reading extensively. Knowledge accumulation allows investors to make rational judgments and understand the world better than competitors who rely on surface-level information. Character development. Skills matter, but character discipline, honesty, patience, and emotional stability determines whether those skills translate into results. Buffett views character as a lifelong asset that directly affects investment performance. Decision-making frameworks. By building sound mental models, individuals reduce reliance on luck or external advice. This aligns with Buffett's broader belief in independent thinking. Chapter 12 concludes that personal growth compounds just like financial capital. Strengthening one's abilities increases earning potential, enhances judgment, and provides resilience through economic cycles. For Buffett, the most reliable path to long-term financial success begins with improving yourself. Chapter 13 highlights Warren Buffett's view that habits both good and bad shape long-term outcomes, far more than momentary decisions. Mary Buffett and David Clark emphasize that behavior, once repeated, becomes automatic, and this automaticity can either compound success or compound failure over time. Buffett compares habits to chains that are too light to feel at first, but too heavy to break once they have formed. The chapter explains that Buffett attributes much of his success not to unusual intelligence, but to the disciplined habits he built early in life: consistent reading, rational thinking, saving money, avoiding debt, and maintaining emotional stability. These habits created a framework that supported good decisions for decades. The power of habit, in Buffett's view, lies in its compounding effect. Small behaviors, repeated consistently, become large advantages. Mary Buffett and David Clark describe several categories of habits. Buffett encourages individuals to cultivate financial discipline. Regular saving, careful spending, and avoiding unnecessary debt create a foundation for long-term financial security. Analytical thinking. The habit of seeking data, questioning assumptions, and thinking independently prevents emotional and impulsive decisions. Emotional control. Buffett stresses habits around managing greed, fear, and impatience, three behaviors that typically lead investors astray. Integrity and character. Ethical habits determine how others trust you, which directly influences long-term opportunities in business and investing. The chapter also warns that bad habits such as overspending, following the herd, or chasing short-term gratification tend to reinforce themselves if not corrected early. Buffett believes breaking these patterns becomes increasingly difficult as they compound over time. Chapter 13 concludes with a practical insight. Success is largely the result of disciplined habits, practiced consistently over years. For Buffett, cultivating the right habits early is one of the most reliable ways to build a strong financial and personal foundation. Chapter 14 focuses on Warren Buffett's caution against taking unnecessary risks, especially risks that threaten essential financial security. Mary Buffett and David Clark explain that Buffett consistently warns investors not to jeopardize what is important and already secure in pursuit of something unnecessary or speculative. This principle is rooted in Buffett's deep understanding of risk asymmetry. The potential upside of risky behavior is rarely worth the downside if the downside threatens one's stability. The chapter highlights that many financial mistakes occur because individuals overestimate potential gains while underestimating the consequences of loss. Whether it is chasing high-return schemes, using excessive leverage, or trying to time the market, these behaviors expose investors to risks that could erase years of progress. Buffett argues that wealth building is a cumulative process, and a single large mistake can destroy compounding benefits that took decades to build. Mary Buffett and David Clark use Buffett's reasoning to emphasize how he evaluates risk. Before making any decision, Buffett asks whether the potential reward justifies any possibility of catastrophic loss. If the answer is no, he walks away, even if the opportunity appears profitable. He prefers certainty of long-term compounding over the illusion of quick gains. The chapter also discusses Buffett's aversion to debt. Leverage magnifies mistakes and forces investors into decisions driven by fear rather than logic. By avoiding debt and maintaining a margin of safety, investors ensure they never have to risk essential assets for non-essential returns. Chapter 14 concludes with a practical takeaway. True financial wisdom lies in protecting what you already have before pursuing more. Buffett teaches that survival is the first rule of compounding. When investors refuse to risk what they need for what they don't need, they preserve both capital and peace of mind, the pillars of long-term success. Chapter 15 emphasizes Warren Buffett's long-standing belief that simplicity is a competitive advantage in investing and decision-making. Mary Buffett and David Clark explain that Buffett avoids complex strategies, complicated financial instruments, or businesses with opaque operations. His reasoning is straightforward. Complexity increases the likelihood of errors, while simplicity allows for clarity, discipline, and consistent execution. The chapter outlines that Buffett's investment framework is built on principles that are easy to understand but difficult for most investors to follow. These include buying businesses with predictable earnings, strong competitive positions, and straightforward business models. If a company's economics cannot be explained clearly or understood within a few minutes, Buffett considers it outside his circle of competence and rejects it. Mary Buffett and David Clark highlight that many investors mistakenly believe sophistication leads to better results. They chase intricate formulas, exotic financial products, or high-frequency strategies. Buffett views this as a trap. Complexity often hides risks, inflates confidence, and distracts investors from fundamental economics. In contrast, a simple approach grounded in intrinsic value analysis and long-term thinking reduces noise and improves decision quality. The chapter also discusses how simplicity strengthens emotional discipline. Investors who rely on complex systems are more likely to react to short-term market movements or external opinions. Those who follow a simple, principle-driven strategy are less susceptible to emotional swings, making them better equipped to stay rational under pressure. Furthermore, Buffett believes simple businesses are easier to monitor, evaluate, and own for the long term. Predictability allows compounding to work effectively, while complexity introduces uncertainty that can disrupt long-term performance. Chapter 15 concludes with a clear message. Simplicity enhances both understanding and results. For Buffett, keeping things simple is not a lack of sophistication, it is a deliberate strategy to improve clarity, reduce risk, and enable long-term financial success. Chapter 16 reinforces one of Warren Buffett's core investment philosophies. Investors should think like business owners, not stock traders. Mary Buffett and David Clark explain that Buffett does not view a stock as a ticker symbol or a short-term trading vehicle. Instead, he sees each share as a proportional claim on a real business with real economics, management, customers, and long-term prospects. The chapter highlights that this mindset dramatically shifts how investment decisions are made. When Buffett evaluates a company, he focuses on fundamental economics, revenue stability, competitive advantage, capital requirements, profit margins, and management quality. Market fluctuations or short-term volatility play almost no role in his decision-making. His objective is to determine whether the underlying business can produce consistent, growing earnings over many years. Mary Buffett and David Clark emphasize that this business owner mindset also prevents emotional behavior, Traders often react to temporary price changes, headlines, or market sentiment. Business owners do not sell their companies simply because someone else offers a different opinion. Buffett's approach eliminates the impulse to panic sell or chase trends, because the focus is on intrinsic value, not market noise. The authors also note that thinking like a business owner helps investors avoid companies with weak economics, businesses with poor competitive positions, unpredictable earnings, or high capital needs are unattractive when viewed through a long-term operational lens. This filter protects investors from speculative or deteriorating opportunities. Another insight from the chapter is that ownership thinking encourages patience. Great businesses compound over time, and long-term ownership allows that compounding to create significant value. Buffett is willing to hold a strong business indefinitely if its fundamentals remain intact. Chapter 16 concludes with a clear takeaway. Successful investing requires understanding and evaluating the business itself, not the stock price. By adopting an owner's mindset, investors make more rational, informed, and long-term decisions, aligning their strategy with Buffett's proven approach. Chapter 17 centers on Warren Buffett's philosophy that avoiding mistakes is just as important as making good decisions. Mary Buffett and David Clark explain that Buffett attributes a significant portion of his long-term success not to extraordinary stock picks, but to consistently steering clear of behaviors and situations that destroy capital. The chapter outlines several categories of pitfalls Buffett urges investors to avoid. Speculation over analysis. Buffett warns against buying stocks based on predictions, rumors, or short-term momentum. Speculation disconnects the investor from the underlying business and exposes them to unpredictable market forces. Businesses without predictable economics. Companies operating in rapidly changing industries or those lacking stable demand patterns are inherently difficult to value. Buffett avoids them because uncertainty creates a wide range of possible outcomes, many of which can permanently impair capital. High debt and leverage. Leverage magnifies both gains and losses, but Buffett focuses on its destructive potential. Debt forces companies and investors to act under pressure, often making poor decisions to satisfy creditors. The chapter emphasizes Buffett's rule: avoid businesses whose survival depends on borrowed money, bad management, and poor incentives. Even a strong business can be damaged by managers who prioritize personal gain over shareholder value. Buffett avoids companies where incentives are misaligned, transparency is weak, or leadership lacks integrity. Complex or opaque investments. Investments that cannot be clearly understood introduce hidden risks. Buffett's stance is that if a business or financial instrument is too complicated to explain simply, it should be avoided. The overarching message in Chapter 17 is that capital preservation is a strategic advantage. By avoiding high-risk behaviors, emotionally driven decisions, and structurally flawed businesses, investors significantly increase the probability of long-term success. Buffett's insight is simple. You don't need to be brilliant, just avoid the big mistakes. Chapter 18 emphasizes Warren Buffett's belief that extraordinary financial success does not come from complex strategies, extreme risk-taking, or brilliant insights. Instead, it comes from applying a few fundamental principles with consistency and discipline over long periods. Mary Buffett and David Clark explain that Buffett rejects the myth that superior investing requires genius-level intelligence or access to privileged information. His results come from a methodical, repeatable approach grounded in simplicity. The chapter highlights several components of Buffett's philosophy. Rational decision-making. Buffett focuses on logic rather than emotion. He evaluates businesses based on intrinsic value, competitive advantage, management quality, and long-term economics, not on market sentiment or speculation. Patience and consistency. Extraordinary results stem from compounding, which requires time. Buffett avoids unnecessary trading and allows his best investments to grow uninterrupted for years or decades. Circle of competence. Buffett only invests in businesses he fully understands. Limiting decisions to areas of competence reduces errors and increases the reliability of outcomes. Avoiding major mistakes. Success is partly achieved by avoiding destructive behaviors such as over-leveraging, following the crowd, or chasing quick gains. Mary Buffett and David Clark point out that Buffett's edge is not his ability to find exotic opportunities, but his refusal to deviate from principles that work. His approach is intentionally straightforward: buy great companies at sensible prices, hold them for the long term, and stay emotionally steady regardless of market noise. Chapter 18 concludes with a core insight: ordinary actions, executed with extraordinary discipline, produce extraordinary results. Buffett's investment strategy demonstrates that consistency and clarity are more powerful than complexity or brilliance. Chapter 19 expands on Warren Buffett's belief that long-term success is determined more by avoiding major mistakes than by making numerous brilliant decisions. Mary Buffett and David Clark explain that Buffett's investment career demonstrates a simple but powerful truth: you don't need dozens of exceptional choices, you only need a few well-reasoned decisions that compound over time, paired with the discipline to avoid catastrophic errors. The chapter highlights that many investors try to outperform by constantly seeking the next big opportunity. This excessive activity increases the likelihood of poor judgment, emotional reactions, and speculative behavior. Buffett's approach is the opposite. He remains highly selective. He waits for rare situations where the business is strong, the valuation is sensible, and his conviction is high. These few core investments drive most of his results. Mary Buffett and David Clark emphasize several components of this philosophy. Focus on high-quality decisions. Making a few high-quality investments is more effective than spreading effort across countless marginal opportunities. Each decision must be rooted in strong fundamentals, not excitement or speculation. Avoiding major mistakes. Much of Buffett's success comes from avoiding poor businesses, excessive debt, unreliable management teams, and unpredictable industries. Eliminating high-risk situations dramatically increases long-term returns. Letting compounding work. Once a sound decision is made, Buffett allows time and compounding to create value. Frequent changes dilute results, while long-term holding amplifies them. Chapter 19 concludes that consistency and risk avoidance matter more than frequency and complexity. Buffett's message is clear: investors don't need to be right often, they just need to be right when it matters, and avoid the actions that permanently destroy capital. This disciplined philosophy is a cornerstone of his long-term success. Chapter 20 builds on Warren Buffett's well-known observation that habits, especially bad ones, form quietly and tighten over time, becoming extremely difficult to change. Mary Buffett and David Clark explain that this principle applies not only to personal behavior, but also to financial decision-making, professional discipline, and long-term investment performance. The authors highlight Buffett's view that individuals often underestimate how quickly repeated behaviors solidify. Early actions may seem insignificant, but over months and years they shape thinking patterns, emotional responses, and financial routines. Good habits compound into stability and success. Bad habits compound into risk, inconsistency, and financial vulnerability. Buffett identifies several destructive habits that investors must recognize early. Emotional decision-making. Frequent reactions to market noise, fear during downturns, or greed during rallies become habitual. Once these reactions set in, they undermine rational analysis. Short-term thinking. Constantly seeking quick gains or immediate feedback encourages speculation over time. This mindset becomes automatic and disconnects investors from fundamental evaluation. Overconsumption and poor financial discipline. Spending beyond means, relying on debt, or failing to save may start small but solidify into long-term financial instability. Intellectual laziness. Relying on shortcuts or outside opinions instead of independent analysis becomes habitual, reducing decision quality over time. The chapter also emphasizes Buffett's positive alternative, intentionally building habits of reading, critical thinking, emotional restraint, and long-term focus. These habits increase an investor's ability to make sound decisions even under pressure. Chapter 20 concludes with a clear warning: habit formation is inevitable, but the direction is optional. Investors who consciously build constructive habits early gain lifelong advantages, while those who ignore their habits risk becoming trapped by patterns they can no longer change. For Buffett, mastering habits is a foundational element of mastering investing. Chapter 21 highlights Warren Buffett's core belief that investment success is determined by the quality of decisions, not the quantity of decisions. Mary Buffett and David Clark emphasize that modern financial culture often glorifies constant activity, frequent trading, rapid reactions, and non-stop market monitoring. Buffett views this behavior as counterproductive. Investors are not rewarded for effort, motion, or busyness. They are rewarded only when their decisions are correct. The chapter explains that excessive activity introduces several risks. Frequent trading increases transaction costs, taxes, and emotional pressure. It also encourages short-term thinking, shifting focus away from business fundamentals and toward price movements. Buffett avoids these traps by maintaining a long-term orientation and acting only when opportunities clearly align with his investment criteria. A key theme is the discipline to wait. Buffett believes that rational inactivity is a powerful strategic tool. Investors should sit still until the right business, the right price, and the right conditions appear. Acting simply because the market is open or because others are active leads to unnecessary mistakes. By contrast, selective, high-conviction decisions produce stronger returns with fewer risks. Mary Buffett and David Clark also highlight Buffett's criticism of professional pressures. Portfolio managers often feel obligated to do something to justify their roles. Buffett rejects this mindset. He argues that the best professionals focus on being right, not being busy. A single well-reasoned investment can outperform years of high-frequency trading. Chapter 21 concludes with a practical insight. Investors must detach effort from outcome. Markets do not reward noise or motion. They reward clarity, patience, and accuracy. Buffett's philosophy teaches that superior results come from thoughtful decisions made infrequently, but executed with conviction and approach that aligns perfectly with long-term wealth creation. The new Tao of Warren Buffett distills Warren Buffett's investment philosophy into a set of timeless principles that revolve around discipline, rationality, and long-term thinking. Across 21 chapters, the book consistently reinforces one core message: extraordinary financial results come from simple rules executed with relentless consistency. Buffett's strategies are not built on complexity or prediction, they are built on clarity, behavioral control, and a deep understanding of business fundamentals. The book begins by emphasizing capital preservation. Buffett's early rules, never lose money, set the tone for an investor mindset, focused on avoiding permanent loss rather than chasing constant gains. Every chapter that follows builds on this foundation. Whether it's waiting for the right pitch, recognizing trustworthy people, or avoiding speculation, Buffett's framework prioritizes intelligent inaction over reactive behavior. Another major theme running through the book is circle of competence. Buffett repeatedly encourages investors to operate only in areas they truly understand, whether the topic is pricing power, competitive moats, or predictable earnings. The book highlights Buffett's refusal to engage with businesses he cannot clearly evaluate. This disciplined narrowing of focus lowers risk and increases consistency. Behavior plays a central role as well. Many chapters warn that the investor's biggest enemy is not the market, but their own emotions. Fear, greed, impatience, and the desire for action damage returns more than poor information or economic cycles. Buffett's emphasis on emotional control, patience, and long-term thinking provides a behavioral blueprint for anyone aiming to build wealth safely. The book also highlights the importance of management quality, ethical behavior, and aligned incentives. Buffett does not simply evaluate numbers, he evaluates people. Chapters on integrity, transparency, and trustworthy leadership make it clear that character is an economic factor, not just a moral one. A great business run by bad people becomes a bad investment. Another pillar of Buffett's Tao is simplicity. Whether evaluating a company, making financial decisions, or structuring personal habits, Buffett avoids complexity because complexity hides risk. Predictability, clarity, and straightforward economics are what allow compounding to work efficiently. The later chapters zoom out and connect investing principles with life principles, habits, personal development, continuous learning, and self-investment become central topics. Buffett believes the greatest competitive advantage is not a stock pick. It's the individual's mindset, discipline, and character. Collectively, the book forms a system. Protect capital. Think independently. Stay within your circle of competence. Avoid complexity, speculation, and emotional decisions. Seek great businesses, not exciting stocks. Value trustworthy people. Be patient, rational, and selective. Invest in yourself first. When combined, these principles create a durable blueprint for long-term wealth and stability, one that any investor, regardless of experience, can apply. If you enjoyed this breakdown of the new Tao of Warren Buffett and want more book summaries that actually improve your financial thinking, hit that like button so YouTube knows this content helps you. And if you're serious about building wealth the smart way, not the risky way, subscribe and turn on notifications. We cover the top financial books, wealth building frameworks, and proven investing principles every week. Finally, drop a comment. Which Warren Buffett principle hit you the hardest? Your reply helps shape the next video. Let's grow smarter together.